Morning, everyone. I'm here to talk about the launch of new luxury product for our new high net worth individuals. We have been doing a lot of research on this thing, and we've already invested 200,000 pounds. We'll have to additionally invest 5 million more pounds, and the market value of this project will be 9 million pounds. The project life cycle will be 5 years, and the WACC will be 7.14%. So, Summit Trail and Co. We are a luxury company specializing in personalized mountain expeditions. We focus on providing a lowering experience to our customers. With all this experience, now we want to make mountain experience more accessible and fun to everyone. So based on the data that we've collected from our marketing team, this is the projected cash flow that we've come up with. We're going to invest 5 million for helicopter, 1 more million for working capital. That will be paid back at the end of the project. And we've already invested 200,000 pounds. The depreciation will be 5 years, though the life of helicopter is 7 years. We are considering both life of the project and life of helicopter to be 5 years. The salvage value will be 200,000 pounds, and the variable cost will be 12,000 pounds per client. So WACC, it is a financial metric representing a company's average cost of capital from all sources, including debt and equity. So in this project, we have the WACC of 7.14%, showing that lower WACC require less budget, poses less risk, and has a higher profitability, which is just the opposite for projects with higher WACC. So significance are it helps in making investment decision, it helps in creating the valuation of project or organization, and also helps in risk assessment. NPB and payback period. The project will be able to pay back its initial investment between third and fourth year at WACC 7.14%. The present value of the cash flow will be 8.99 million, and the net present value of the project will be 2.94 millions at 7.14% WACC. Now, talking about the NPB and PB payback period based on 18% WACC or the historic WACC, the project will now be able to pay back itself between fourth and fifth year. The present value of the cash flow will now come down to 6.83 millions, and the net present value will come down to 777,000 pounds only. Some of the investment appraisal techniques are net present value. It is the difference between expected present value of cash inflow and present value of cash outflow. If NPV is greater than zero, we can accept the project. It accounts for the time value of money and considers all the cash flow. Internal rate of return is the discount rate at which NPV of a project is zero. Higher IRR makes investment attractive. If IRR is greater than WACC, we can accept the project. This is usually used for comparing between one or two or more projects. Now, talking about discounted payback period, this is a time taken to pay back the initial investment while accounting for the time value of money. Though this is more precise than payback period, but it still does not account for the money that will come back after payback period. Now, talking about accounting rate of revenue or ARR, it evaluates an investment's profitability based on accounting profits, not on based on cash flows. If ARR is greater than required rate of return, we have to accept the project. If it is less, we cannot. So the pros are it is easy and simple to calculate. And again, it is good for comparing between one or two or more projects. Now, some of the source of funding are equity funding. This is done by selling ownership shares. Usually, some of the options are angel investor, venture capitalists, private equity firms, and IPOs. The pros is the extensive network and expertise of the investors. Debt financing, borrowing the money to be repaid with interest. Some of the options are bank loan, bond, microfinance loans, and so on. So some of the pros are interest will be tax deductible, and the ownership will remain with the business owners. Internal funding, it is usually done for expansion or making some better operations. So some of the sources will be retained earning, cost cutting, and asset sales that are rarely being used. Some of the pros will be there will be no pressure of performance, there will be low financial risk, and there will be no debt. Short-term financing is done to have an access to the quick fund required. Usually it is between 1 and 3 years, and the pros are it is fast approval and bridges the cash flow gap. So conditions for getting the loan is status of the business, whether it's operational or starting, track of expenses and earning, inventory, sources of revenue, collateral, and the compliances, whether the company is following the government compliances or not. So talking about the conclusion, the WACC, calculated WACC is 7.14%, which produces greater NPV and shorter payback period. At 18% WACC historic, there is lower NPV and a longer payback period. The payback period is simple payback period is 2 years and 9 months. The discounted payback period is 3 years and 2 months, and the discounted payback period at 18% WACC is 4 years and 3 months. And similarly, and net present value at 7.14% is 2.945 million, and 18% is 777,000 million, sorry, 777,000 pounds. Thank you. And these are some of the calculations that I have done to come up with this presentation. Thank you.